we begin Chapter 7, learning about having charge accounts and credit cards. So we're going to talk about some vocabulary to start off this section in Lesson 7.1, where we're going to talk about our account statements. So if you need to pause the video and write these vocabulary terms in your notebook, go ahead and do so now. So our first vocabulary word is a charge account. So a charge account is an account that you would have with a certain business. So maybe you have a charge account with your local grocery store or your local gas station. And what happens there is you can stop by and get gas and they'll add that to your monthly charge. And at the end of the month, that gas station will send you a bill and you'll pay for all of the gas that you purchased there for the month. So it's an existing line of credit at a business that issued it. So these are going to be very business specific, and they're usually typically your small businesses in your community that will allow you to have those. A credit card is more on a bigger, grander scale. So that credit card is issued to you from a bank, maybe like Citibank or Bank of America or Capital One, American Express. Those are all very popular credit cards. Now, those are not going to restrict you to any specific business. Those are going to be more universal. You can use those at the gas station. You can use those to make online purchases. You can use those at the grocery store. But it's a card that's authorizing purchases on credit. So you can purchase that on that line of credit, and then you pay back your amount at the end of the month to that specific bank. Now, finance charge. This is how the banks make their money. This is how the charge account companies make their money, because their interest that's charged on any leftover balances. So that's why it's very important to try to get those credit cards down to as low of a balance as possible, because anything that's left over and carried over to the next month becomes interest that's added on. So they tack on that interest for the final remaining balance. And they might also incur some fees on that account as well as interest charges. But at the end of the month, whether it's a charge account or a credit card, you'll receive an account statement that has all of your charges on there, any finance charges you may accrued throughout the month, and any payments that you made in the previous month listed on there for you to calculate and make sure everything adds up for your actual expenditures. So you want to always keep your receipts and make sure your account statement is accurate and there are no discrepancies. So our lesson formula is quite simple today. So to find our new balance, whether it's a credit card or a credit account, we're going to start with the previous balance. Now, hopefully we're starting at zero, but that's not always the case. We're starting with what's left over from the previous month. You're going to add any finance charges, usually by percentages, from the previous balance. You're going to add all of your new purchases in there, and then subtract any payments or credits. So if you made a return, you would see that in the subtraction, because that would be considered a payment because you're taking that off your balance. All of that together gives you what your new balance is for the month. So let's look at an account statement. So this is just a generic account statement that you would receive at the end of the month. Here you're going to see where you're to make your check payable to and an address. Some important things to look for are your due dates. So you want to make sure you get that payment into the mail or mail it electronically through your checking account so that it is received by that date. If it's not, then you can accrue a late charge. You're also going to see a minimum payment due. Now, if you only always pay the minimum payment, it's going to take you very long to pay that balance off. So you want to try to get higher than the minimum payment due every month so that you're spending less on interest for those charges. You can see here that it's showing the new balance, and we're going to see how we calculate that in a minute. And then you're going to list the amount enclosed. So what would happen here is you'd rip off the top of this and you'd send this in with your payment because your account number will be on there. And on your check, you'd want to also write that account number so that if something got mixed up in the mail, they can know whose account to credit for that payment. Okay, so down here you're going to see a list of all of your transactions. Now this is where you definitely want to double check. You want to check the statement every month to make sure there's no discrepancies and that your card might not have been stolen and somebody is out spending money on your account. So you always want to check over your credit card statement every month to make sure everything is accurate. So then you can see down here the previous month balance, that there was a $40 payment, all of the new charges, so this would be the new charges added into here, the finance charge, so the finance charge comes from the percentage of that previous balance, and that gives us a total of the new balance. So down here is just some account information. It shows you what your average daily balance is. It shows you what the monthly periodic rate and the annual percentage rate is, what the finance charge accrued is, and it also gives you some information about your credit limit on the account. So that's just a sample of a credit card statement that you may get for your credit card. Let's look at a scenario. So James's previous balance on his credit card was $439.54. He made a purchase for gas, clothing, and a birthday present. He made a payment in February for $250, and his credit card charged him $7.91 in finance charge. What is his new balance? So his new balance is going to start with his previous balance of $439.54. In addition, he made 3 new purchases, and he made a payment for $250. So I'm going to take that $250 off, and we're going to add on that finance charge of $7.91. So when we calculate all of that out, the new balance on James' account should be $423.13. So it's just really important that you understand what gets added and what gets subtracted to the account and what the differences are. I'm going to give you some examples on Google Classroom. Make sure you practice those and get those uploaded.